Apple's stock is currently trading at $140 and remained flat during the day. If we take a look at the full month, we can see it dropped over about 14% and remained flat during the year. So it's about time to take a look at a high quality company like Apple. Apple just recently started selling their new iPhone and they already backed off plans to increase production. This could be a bad sign for the next year because it probably shows us first signs of recession and it shows us that Apple's products can be hit too by a recession. But if we take a look at the third quarter results published on July 28th, we can see they had a record revenue with $83 billion, which was up 2% year over year, and quarterly earnings of $1.20. Let's also take a quick look at the condensed consolidated statements of operations from Apple. We can see net sales remained roughly flat. Okay, they grew a little bit. We can also see that operating expenses increased and operating income also increased, which is really what we like to see. If we take a closer look at the net sales by reportable segment, we can see most of the money is made in America, but Europe and Greater China are also very important regions for Apple. If we take a look at the net sales by category, we can see yes, the iPhone is by far the most important product for Apple, which shows us that Apple isn't as diversified as a company like Microsoft, for example, and that Apple is a little bit more cyclical than Microsoft because they are dependent on the new launch of an iPhone. But one thing that Apple, Microsoft and Alphabet have in common is that they all have very high free cash flow, which is really what we like to see because we are currently in a series where we take a look at high free cash flow companies because there's a lot of data suggesting that companies with a high free cash flow yield perform better during tough times and recessions. That's simply because they are not dependent on money to get money from the market. In bad times, the market isn't as willing to give money to companies and then they have to borrow the money. Companies like Microsoft, Apple, Alphabet, they don't have to borrow money. They have their own money and they can use this free cash flow to do smart acquisitions or to do buybacks. And that's exactly what we are seeing right now. And we like seeing this because there's also data suggesting that companies who use their money to do stock buybacks have a high chance of outperforming the market. Let's take a look at Apple's stock buybacks. We can see they are buying back the stock with a lot of money, 22 billion. And if we take a look at the last 5 years, they have been constantly buying back shares. And I think that's a big reason why Warren Buffett likes Apple so much, because his part of Apple constantly keeps increasing and he doesn't have to pay taxes on this. Let's take a closer look at Apple's past year's financials. We can see the Apple stock has been a huge success for every investor, especially in the past years. We are currently trading at a little bit higher PE ratio, it's 23. I think Apple deserves a little bit of a premium because it's a high quality company. The forward PE is 22 and we can see the market cap is very high. It's over $2 trillion and the dividend yield is currently at 0.63%. If we take a look at the revenue per share, we can see that it constantly kept increasing. The same picture with earnings per share. It constantly kept increasing even from 2006 till now. I think there's no year where earnings per share decreased, which is fantastic to see, or just a few years, not that many. Free cash flow per share also increased steadily over time. And I think Apple's annual growth rates for the last 5 and 10 years are very impressive. You can see revenue growth for the past 5 years has been over 13% and for the last 10 years over 10%, which is double-digit growth. We like to see, we want to have top-line revenue growth, and cash flow also increased very high, over 11% over the last 10 years and 17% over the last 5 years, roughly in line with earnings, which is what we want to see. One thing that I would like to mention is that Apple is by far the biggest holding of Warren Buffett and Berkshire Hathaway. You can see it's a little bit over 40% of the portfolio with an insane value of 122 billion. And during the past quarters, we have seen that Warren Buffett constantly kept adding Apple to their portfolio if it dropped below a certain level. So now Let's get into valuation. We can see the numbers of shares have constantly decreased over time, and I expect them to steadily decrease in the next years. Revenue for the past and the future estimations by analysts should be about 8 to 9%. We have seen in the past 5 years it has been a little bit higher with over 10%. Free cash flow should also grow, should even grow double digits, low double digits. Okay, let's take a look at our normal case. I like to be very conservative. Let's say Apple is ready to grow with 7%, then steadily decrease it over time as our projections get more uncertain. A fair free cash flow yield of 7% seems reasonable for that kind of growth. Maybe we could type in 6%. Okay, let's also take a look at the best case scenario. We have seen it's supposed to grow with 10%. Let's keep it at 10% for 3 years and then decrease it a little bit over time. Maybe this scenario could happen if services keep getting more and more important and they have that recurring revenue. And then a fair free cash flow yield would be maybe 5%. Okay, and let's take a look at the worst case scenario. I think in the worst case scenario, Apple will still be able to grow, but maybe just 5% and then 4%, which is very, very conservative, I think. Then the 7% free cash flow yield would be fair. Okay, let me just type in the stock buybacks. I'm also considering those. Okay, and now we can see in our normal case scenario, we have a possible internal rate of return of a little bit less than 9%, which would underperform the S&P 500, or would have underperformed the S&P 500 in the past. Our best case scenario looks very nice with 12% internal rate of return, and our worst case scenario still looks reasonable to me, 6.5% of return. Let's take a look at the combined expected annualized return. We see it's 9%, which is a decent return. I think it would beat an MSCI World, and I truly believe that Apple can grow faster than our expectations that we just typed in. But I'm actually not sure what to do with Apple. As I recently just analyzed Microsoft and Alphabet, I think I liked Alphabet best because we had a lower valuation, yes. And I like Microsoft a little bit more because the company is more diversified and we have the cloud business as a growth driver. I'm not sure if I will be adding Apple to my portfolio, but I can totally understand if people want to own Apple because it's a great company and I think they will do well with it. You can also see if the stock price drops again, your internal rate of return increases. So thank you for sticking till the end. If you have any questions or suggestions, feel free to leave a comment and don't forget to subscribe.